My name's Jennifer Agin. I'm a CPA with Wolf, Wilson & Phillips here in Zanesville. I have a master's in tax. My undergrad was from Ohio State. I have a double major in accounting and finance. And I primarily head up the return preparation in our office. I do estates and trusts, corporations, partnerships, individuals, pretty much all the tax return stuff. I do all the tax research for our office. And I also do the anything payroll taxes, financial statements, all those sorts of things. Most of them pass through my desk before they leave our office. As far as 2013 goes, Alan had said to give you guys some insight as to for some tax planning ideas for 2013 and potentially moving forward. As far as ideas for 2014, right now your guess is probably as good as mine. We're probably looking for a major tax reform bill that will happen. Whether it happens in 2013 or happens in 2014, we don't know yet, but if it is in 2014, it'll probably have a retroactive piece to it. So what we do know for 2013, at least anybody that gets a paycheck has realized that starting with the first pay in 2013, we all had a 2% pay cut. And anyone that's self-employed, filing a Schedule C or the other, what you're going to find is hopefully you are increasing your estimated payments for 2013, because if not, you're going to have a fairly sizable increase, 2%, to your tax liability when you file your tax return in 2014. So Social Security, we were operating with a 2% reduction in the Social Security amount for 2011 and 2012, and they did not renew that. So that's why we all saw that. So it doesn't matter who you are, as long as you work. If you are working at minimum wage, if you're working for $1 million a year, if you're self-employed, all of us took that 2% on the chin. So that's one of the changes that happened for 2013, and most folks have realized it now because our phones rang off the hook the first month. I think you made a mistake on my payroll check, it's less. No, I'm sorry, that's not a mistake. So unfortunately, it's not a mistake. So the expenses for 2013 that were renewed with the fiscal cliff passing, which happened on January the 1st, is Section 179 and Section 168K. 168K is a bonus depreciation, and bonus depreciation is if you purchase a new asset during the year, that new asset, you can automatically write off 50% of it immediately. So if you paid $1,000 for an asset, you could take $500 of it immediately, and the other $500 you would depreciate on its normal term. So you're going to get maybe $600 in the first year, and then the other $400 over the next so many years. So new assets only, and it was extended on January 1st through the fiscal cliff bill through December 31st of 2013. So it was one of them that was supposed to have sunset on December 31st of 12, but was renewed. So it was part of the fiscal cliff. So on January 1st, 2013, when they passed that, they extended it through December 31st of this year. So there's bonus depreciation, but that's only available on new assets. So if you purchase something used, that would not qualify. But Section 179 is also another section that was extended through the fiscal cliff as well. And Section 179 is a nice section because it doesn't have to necessarily be new assets, it can be used assets. And Section 179 allows you to write off 100% of an asset when you purchase it. So new or used and 100%. But it has limitations that go along with it. Of course, you can't do real estate, nothing like that. It has to be machinery, equipment. It can be vehicles, but there's some limitations with vehicles as well. The limit for Section 179 was extended too. So the first $500,000 of assets that you would purchase can be written off. If you buy more than $2 million in assets during 2013, then that $500,000 starts to be reduced. most of the businesses I deal with are small businesses, and I don't usually have a problem. I have a couple clients that usually buy more than a couple $1 million a year, but for the most part, most of my clients are small businesses, and we never have to worry about purchasing more than $500,000 anyways. But the big change that's coming, or potentially coming in 2014 with 168K and Section 179 is 168K is probably going to leave us. 168K came to us after the towers fell as a stimulus to try and get businesses to purchase new assets. It was here for a few years, went away, was resurrected, was supposed to die again, came back. I just don't see it being something that they continue to allow. So I don't see Section 168K being something that will survive past this year. So 179 is really probably the only option that you'll have left, and 179 is great as long as it stays with the limits that we have currently. What they're talking about in the bill for 2014 is changing Section 179, and changing that would be very detrimental to most small businesses because it would go back to pre-Bush numbers, and that means that you would have Section 179 limit of $25,000. And many of my businesses buy more than $25,000 of new assets in a year. I mean, if you buy a new truck or a new van, you've exceeded that. So that's a piece that worries me for my small businesses, because I'm not sure how that's going to play out, and we'll just have to listen and see what ends up happening. But certainly being an advocate to make sure that they keep it at a higher level, at least the 125, which is where it was for quite a few years, I think would help our small businesses.
So then this is the year to make purchases if you're going to do it. Is that what you're saying?
Well, I kind of go back and forth on that, because the other piece of 2014 is the tax brackets are changing. They say they're going to take away the 10% bracket. They're going to increase the highest bracket, and then they're also widening the brackets. So potentially, if you had years that you might want to pay tax, it would have been last year and maybe this year, because you might need to save up some of those expenses for 2014 if we see such a big change in what the tax bracket codes are. So right now it's a kind of stay tuned to see, and hopefully they make some decisions before the end of this year, so that if they do decide to make some of those changes, we'll know about it, and we could say, you know what, no, if you want to buy something big, buy it this year, so we can write it all off this year. But right now we just don't know. I mean, just don't know yet. It's put you in a huge limbo situation with making decisions and planning.
We don't even know when they might make the decision.
No, because they were supposed to have signed the fiscal cliff well before the end of the year, and before they ever left session for Christmas holiday, they were supposed to have signed it, and that didn't happen. The year before, if you remember, in 2011, they signed the bill. It wasn't called the fiscal cliff that year, but they signed the bill the day before Christmas. So it got signed, and it did give us a week to make some changes or do some planning. But this year, it didn't. The way it happened, it was unfortunate, because they signed it on January the 1st, and it made changes for 2012. How can you plan for that? You can't. That it's passed. So there's nothing you can do. It is what it is. The other piece of depreciation that's seeing a huge a huge change is the IRS introduced a temporary regulation, and anytime they issue a reg, it's law. So you're supposed to follow it. Temporary regs go through a process of discussion before they become permanent regs. The government doesn't work fast. We have temporary regs that are from the 80s that have not been finalized yet. So as a temporary reg, you are supposed to follow it. But what the reg is talking about is a thing called rotable parts. And when I heard it, and most people hear it, they say, I don't even know what a rotable part is. So I'm going to give you a little bit of history to how this happened. The IRS did an audit on FedEx. And when they did the audit on FedEx, FedEx was bringing in their jets. They were taking their jet engine off. They were having it at a warehouse. They put another jet engine on it so the aircraft could go fly again. They rehabbed those engines, and as the next plane came in, they put the engine on, took the engine off, so forth. They were rotating those engines from their planes. Hence, rotable. That is a rotable part. So what happened was they were under audit, and they had repair and maintenance costs on their tax return for the 1 year of $35 million. And the IRS said, that's not something you can expense in 1 year. We're going to require you to capitalize that. What's that mean? That means you put it on your asset listing and you depreciate it over a period of time. I already told you a $2 million cap. Can they do anything? No. There's no Section 179. There's nothing available for them. Is it a new part? No. It's a reconditioned part. So they're going to take it over probably a 5 to 7 year life. So that's what the IRS wanted. Took it to tax court. Tax court said, IRS, you're wrong. Taxpayer wins. It is a plane. The plane costs millions of dollars. This is one piece of the plane. We disagree with you. It is a repair. FedEx, you can write off $35 million. So the IRS goes back, licking their wounds. And what do they come up with? They come up with this new Treasury reg. And what's the Treasury reg say? It says if you have rotable parts must be capitalized. So in essence, they backdoored it to a FedEx and said you can't do that. Is it a really big deal for small businesses? Initially, I thought no. I don't really need to worry about this. It's not a big deal. But there's two pieces of it that actually, once you do a little bit of analysis, the Treasury reg is very long, but once you do a little bit of analysis on it, there's a couple of things that are potential problems for the small business owner. One of them is if the Section 179 limits do get reduced, and we're dealing with that $25,000 number, whoa, we've got a problem now. Because if you have some of these rotable parts, a transmission, an engine, or whatever, and you're trying to put these on the shelf, now you've used some of that $25,000, and it's potentially minimizing the amount of deductions you may have. So that's the first problem I see with it from a small business standpoint. The other problem that I see with the rotable part thing is when you actually read the Treasury reg, it tells you that if you were to purchase a building, let's say, normally what we do now is we go to an independent third party, usually it's the county that the property is located in, and we look at what their appraiser said that property's worth. They assess a value to the structure, they assess a value to the land. You figure out that percentage, you multiply it by your purchase price, and there you go. You've got a piece for the building that you can depreciate, a piece for the land which is non-depreciable. Things are fine. This Treasury reg actually goes a step further, and it says that's not good enough. That you actually have to have a certified professional come in when you purchase a property, and they have to break it down between the IRS items, which is HVAC, electrical, the roof, the windows. There was some analysis done on this by the AICPA, and they came back and said that for you to just pay the cost of this professional, and I don't even know what that professional is called, but just to pay the cost of that professional, the building would have to be worth at least $2 million for you to even break even. So, I mean, it's absolutely asinine. It just makes absolutely no sense whatsoever. And the AICPA, I went to a continuing ed, everybody was like, you've got to be kidding me. The AICPA, because I said it is a temporary reg, the AICPA is lobbying right now saying this is insane. There's no way this is possible. Most of America is small businesses and we can't do this. And it goes a step further from that. Let's say that you have a property that you placed into service this year or 10 years ago or whatever, and you decide that you're now going to replace the roof or replace the windows. They're telling us that we'd have to go back and have that analysis done to figure out when you purchased that property, how much was that roof worth of your property value. And we would have to dispose of that particular price of the roof before we could install or place into service the new roof, which it just is crazy. I mean, it would just be very, very time consuming and nearly impossible to actually get what they're wanting. I understand where the law came from. You know, it came from the FedEx court case, but ultimately it's just not something that'll work in real life. So another one that we just have to stay tuned for. It's a temporary reg now. It is law. I'm being taped, so I guess I'm following it. But probably not. Probably not at this point. So that's probably the biggest change I see with respect to depreciation, the asset side, and that. Another thing that I wanted to talk just a little bit about was health insurance. And I think we've all heard all sorts of things in the news and a lot of things that we've wondered, how is it going to affect us and what are we going to have to do and so on and so forth. So first one is there is a health insurance credit. And the credit is, just before I go too detailed in it, do any of you have health insurance for your employees that your business pays 50% or more? Okay. If you do, there is a credit. It's been around for a couple of years now. It was part of Obamacare. But there's a credit available to you for the health insurance that you're paying for those employees. It can't be anybody related to the owners. If it's related to the owners, they get taken out of the equation. It has to truly be an employee. They have to make less than $50,000. You have to have less than 25 employees. If you make between 25 and 50, it starts to phase out. If you have between 10 and 25 employees, it starts to phase out. So less than 10 and less than 25,000, you're good. But it is a really nice credit, and I have several of my small businesses that do offer health insurance that have saved significant amount of money. And it is a credit. It's not a deduction. It is a credit. That means a dollar for dollar reduction of what tax you would owe. So I just wanted to make you aware of it if you didn't know, but it's fairly new and available if you qualify for that. So that one's nice, and the return I did today was $700 added to their refund for just the credit. They have a single employee that they provide more than 50% of the health insurance. So it can be a nice little credit. I have another company that has quite a few employees, and their credit ends up being around $20,000. So it's a pretty sizable number. It's a big client. They have several $1 million in sales. But anyways, so it can have a wide range to it, but something not to let get overlooked if you qualify for it. As far as moving forward with the health insurance stuff, 2014 is when the mandate comes in that we've all heard about, that businesses have to provide health insurance for their employees. And currently, if you have 50 employees or less than 50, you are exempt. So you don't have to worry about the mandate, doesn't matter. I can tell you out of the clients I have, almost all of them have less than 50 employees. So it's almost not going to affect any of my clients. However, part of the talk right now is 50 the right number? So we're not sure yet. And where might they go with that? What I have read so far is saying that they feel that maybe 25 might be the better number. Does it really matter for me? Not really. Still, most of my small businesses don't have more than 25 employees, so I'm probably still okay. The only thing that you have to be cautious on is determining whether or not you have 50 employees or not. And sometimes you may say, oh no, I don't. But if you have a cycle to your business, maybe you're a landscaper or you're a a grower of plants or something like that to deal with mowing grass or whatever. You may have that many employees, but only for a couple of months. And you may be a qualified employer for those 2 months and be required to provide the insurance even though you may not have 50 employees for the whole year. So there's some little weird caveats within that law that you have to pay attention to. Again, I don't know, I'm sure you guys don't have any employees, and I'm not sure how many employees the rest of you have, but I'm assuming that most of you are probably under 25, definitely under 50, so it's probably not something to spend a lot of time on, but that's sort of where that is. From a personal standpoint, not as a business owner, but from a personal standpoint, the mandate starts on individuals as well. So if you don't have health insurance, there will be a penalty charged to you on your personal tax return when it's prepared for not having health insurance. So, and that's a process that's going to take a few years to fully phase itself in. And then the other thing that I was going to talk about, those are really the only things I can tell you with some certainty at this point are the things that I've covered. So the other things I put on my list to just briefly talk about, there are some things that have changed, and some of you may already have this information or not, but somewhat recent, within the last year or so, or within this year too. So general expenses with respect to a small business, if you're doing mileage reimbursement to yourselves or mileage reimbursement to your employees, that rate changed as of January 1st. It's now 56.5 cents. It was 55.5 cents for 2012, so we gained a penny. Although our gas went up $1, we gained a penny. I'm not sure how that works, but that's how the government is. The other thing that's been a big change was 1099s. There's been a lot of law. Before Obama even became president, it was really a pet project of his, and it's only continued now that he's in the White House. They did some significant, or at least I guess tried to do some significant reform with respect to 1099s. There was an outcry from the population, and the same senator that proposed the bill asked for its rescission about 6 months after its proposal and passing. So it did have some. It gave you an insight as to where they're trying to go. And in essence, what they're trying to do is require any deduction that you have to require a 1099. If you're deducting it on a return, whether it's as a rental property, whether it's as a business, whatever it is, a farm, whatever, they're wanting you to have to send the 1099 out. That enraged people. They actually picked on landlords. That was the group that they chose to, they felt had a lot of abuse. And like I said, a huge outcry, and they ended up rescinding it. It stays in its original form, which is if you pay anyone $600 or more for services that they are not incorporated, that means they're a sole proprietor, that means that they're an LLC, single member, that means they're a partnership, anything other than a corporation, you must issue them a 1099. If you do not, you are not eligible to take that deduction on your tax return. Period. Simple. That's the rule. That's how it ended up flushing itself back out. It's back to what its original rule was, but what they wanted to do was, it got even crazy too. If you charged something on a Visa card, it was okay, but if you charged it on a Lowe's card, it still had to be 1099 to Lowe's. AT&T for your phone bill, it was just nuts. It was crazy. So at least that one got repealed. So we're still back to where we were. Services, how do you collect that information? Before you pay someone, you should have them complete a W-9 form, keep it on file that gives you their name, gives you their address, gives you their ID number, so that you can issue the 1099 to them. Cell phones also went through a amorphous over the last couple of years. Cell phones were something that is called listed property. Listed property in the eyes of the IRS means that it's property that has the potential for personal use. And if it is, then it's considered listed property. If you have listed property, then you have to determine what percentage of the time is that property being used personally, what percentage of the time is it being used for your business, and then you have to prorate the expense, meaning you can't take 100% of your cell phone bill if you also have only one phone, unless you never use it for anything else, like that happens. So you'd have to make some kind of analysis with that. There was all sorts of issues, court cases filing, all sorts of things that happened. The IRS finally put up the white flag and said, okay, we surrender on this issue. What we decided is it's no longer listed property. Cell phones aren't listed anymore. If the business buys a cell phone for their employees and they give it to their employees for business purposes and they make the occasional phone call, we don't care anymore. You can still write it off. However, there is a caveat that says if it's the phone that you're using for everything, then if you do not want to document every single call to log out the percentage, because we all know that there is a portion of time that we use them personally, if you deduct 75% of your phone bill, the IRS you don't have to do anything. They'll say, okay, we're good with that. If you deduct 76% of your phone bill, you now have to have a detailed listing on a call-by-call basis to prove to them that 76% of your calls were business. If you take 75, you don't have to do anything. So 75 is pretty much the area that we stick with in our office because it's just easier. Yeah, it's just easier. So that's something that's changed. And then I threw this one in, and it can be something business-wise, but it can also be on a personal return, which is charitable giving. Charitable contributions changed significantly. If you walk into Walmart and you put $1 in the Salvation Army bucket, you no longer can deduct that. If you go into Walmart and you put a check for $1 in the Salvation Army bucket, you can deduct that. So any cash donations are no longer deductible. So what if you go to your church and you put $20 in your envelope and you give it to church? Can you deduct that? Yes, you can, because the church is going to give you a giving statement at the end of the year. And even though it was cash in the envelope, you're still okay. What happens is between $1 and $250, you have a check to prove that you made the donation. You're good. Once you hit that $250 number, the rule changes. And at that point, you have to have a giving statement from the organization you gave the money to. And they have to say what you gave them and that there were no goods and services exchanged for it. You got no value for it. If you don't have that, I can't let you deduct it anymore. So $5,000, the rule changes again, and you have to have an actual independent appraisal, and it has to be attached to your tax return to take anything above that. So some changes that happen with that. For a small business, what I always caution them on is when you're coding things for your business, when you code it to charitable giving, that is not a good thing. It is much more beneficial for you, especially these sole proprietor folks I'm talking to and single member LLCs. It is much better for you if you can code it to advertising. So what's the difference between the two? If you go to your church and you give them $50 out of your business checking account because it made you feel warm and fuzzy inside, that's a donation. And there's nothing you can do but a donation. But if you go to your church and you write a $50 check and you say, are you going to put my business card on the back of the bulletin? And they say, well, yeah, for $50 you get that. Now you've made it advertising. And that's a much better deduction for you than what the charitable one would be. Am I saying not to be charitable? Certainly I'm not. I'm just saying that if you have the opportunity to make it a better deduction for you, do it. Because it's going to, what happens is the advertising is 100% deductible against your business income, which reduces Social Security, which reduces Medicare, all of those sorts of things. If it's charitable, it goes on Schedule A. And there's many hurdles to get through. Do you itemize? Maybe, maybe not. If you do itemize, it's still an after, it's a below the line deduction in my world, which means that the only thing you're saving is federal income tax. You're not saving state of Ohio tax, you're not saving Social Security, you're not saving Medicare. So that simple decision that you're making when you make that contribution or advertisement can make a big difference in the tax that you pay. So just a little tidbit there. And the other one I added is something I've added because under audits, the IRS is getting pretty ruthless. And for meals and entertainment, the rule is if you don't have the receipt, the deduction is gone, period. No question asked, it's gone. In addition to that, that used to be the rule. So a lot of my clients were great. They kept all the receipts and they have this big shoebox full of receipts. Well, that's not good enough anymore. If you have an agent show up, what they expect to see now is that receipt needs to be flipped over, and on the back you better have what the business purpose of that meeting was and who was in attendance. If you don't have that, you're probably going to lose it anyways, because you have to prove to them that it had a business nature, not that it was you stopped by McDonald's with your kids to pick up dinner on the way home because you didn't feel like cooking and you threw that receipt in your box. Doesn't work. Nobody would do that. Of course, I wouldn't think so, but that's just something that's came up over. Of course, mileage logs are always an issue that comes up in an audit as well. If you're taking mileage, get a cheap little calendar, throw it in your car and write it down. If you don't, it's going to bite you sometimes. So it doesn't take a lot of time, and it can certainly save you a lot of money and a lot of heartache if you do get into an audit situation. So that was all I really brought. So I figured that maybe you guys have questions for me and I could answer those. I'm pretty informal.
I got a question on itemizing the cell phone calls. cost of the cell phone. I have an insurance agency, plus I have a farm.
Yep.
Can I take a certain amount off for both of them?
Certainly. If you're exceeding 75% of the total, you better be able to itemize it between the two.
Because I mean, right now I'm barely taking, and I just, and the same way with the electric on the farm.
Yeah, it's a hard one.
Yeah.
It's a matter of just trying to come up with a reasonable amount. And normally in an audit situation, if you are reasonable, they really can't argue with you. It's when you get a little overboard on things that if you get greedy, you're probably going to lose. But if you have some thought process to how you came up with your reasoning and how you came up with the amount, and you do it on a consistent basis, and you're probably okay. I mean, can I ever say that you're 100% okay? No. But as long as it's reasonable, you're probably all right. And I have lots of farmers that we take a percentage of utility costs.
What about real estate taxes? Can I take off the
Yes.
tax that's actually on the home?
Oh, no.
Yeah.
No.
So how do I know?
The real estate, you just go to the auditor's website. On the auditor's website, it'll tell you how much the house, the residence is worth and its value. It'll tell you how much the extra structures are worth. It'll tell you how much the land is worth. And then again, you prorate it between those businesses. So if you have a barn on your property and you have 60 acres and 50 of them you use for the farm, then you multiply out what the acreage cost is, you multiply out what the barn cost is, you take that on the farm. The house and an acre or so around the house, then you take on your Schedule A. And if you have, some other portion for the rest, then you take it wherever. So,
That's what I thought.
yeah. But it's all deductible, just making sure that you get it on the right form. The continuing ed class that I went to, the one I always go to, I love because it's all practicing CPAs, and it's nice because they're all small business owners like me and deal with normal people like I deal with. So it's nice because you get different insights about things. And when I went to that one, not this past year, or this 2012, but I went in 2011. I should have brought some of those. I didn't think about it. But when I went in 2011, the lecturer came in and he started his whole day, and he said, "Mosquitoes bite, elephants don't." And I thought, oh God, this is going to be a long day. And so I thought, okay, I'm going to listen to what this guy has to say. And he started going through, and the nice thing about it is they usually give you some real world examples. And he was going through different things, and he'd get to the end and he might say, mosquitoes bite, elephants don't. And it would make sense. And then he finally got to a story, I think it might have even been the second day. And he had a husband and wife. He's on the East Coast, a small little town, a small little practice, probably very similar to mine. And he had a husband and wife. They had an S corporation, had several employees that worked for them. And the IRS came in, and what they wanted to see were the I-9 forms. An I-9 form is a form that you should have on file for every employee that you have. It's part of a new hire packet, which our office makes up for our clients. And the I-9 makes sure that the employee that you've hired is not an illegal immigrant. You keep a driver's license, social security card, green card, whatever, because they can be an immigrant, but they have to be here legally, not illegally. So the IRS came in and they asked to see the I-9s. And the lady was enough wits about her, said, "I will gather that information for you, and if you'd like to come back tomorrow, have those prepared for you." And they can't be unreasonable, and that's a reasonable time frame. So the IRS agent said okay, and they left. They got out to the parking lot, and one of her employees was trying to be helpful and went out and said, but you know what, she keeps all of those online. And the IRS agent closed the car door, came back inside and said, "These should be very readily available. Your employee was nice enough to say that you keep those electronically." And she said, "Yes, we do." So they proceeded to look at them. She had all I-9s except two of them. Who do you think she was missing?
The girl that told IRS she had them.
She was missing her own and her husband's.
Oh, no.
And she was certain that they were born in the U.S. and that there wasn't a problem. There was a fine. Do you know what the fine was? $15,000 per I-9. $30,000 penalty. And what did he follow that up with after he told the story? Mosquitoes bite, elephants don't. And I thought, man, I really need to think about this. And it really bothered me. I went to that, I go to 2 of them, one in October and one in November. And it really bothered me. I really thought about it. I drove home from Columbus and I was like, wow, this is crazy. If any of my clients got that penalty, they wouldn't be in business anymore. And if I could do anything to try and help them with that, I really think I should. Is it my responsibility to do that? Absolutely not. If you hire your own employees and you calculate your payroll, it is not my responsibility to do that. But would I feel bad if one of my clients called me and said, hey, Jennifer, IRS was here and I just got screwed. You know, I owe them $30,000. I'm going out of business today because I can't do it. And I thought, I think I need to do something. So, and there were several other things going on, independent contractor versus an employee relationship, and do you have a business or do you have a hobby, and lots of other little things. So what I did on my Christmas vacation was I made up some handy dandy little checklists. Alan, you probably got one from me that year. I know you did, actually. And I had 4 little checklists. Not every client got every checklist. It depended upon, if I knew you had a business, I didn't give you the one, do you have a hobby or business, because I knew you had a business. But my little side farmers and my little person that works out of his garage or whatever, I sent them those. I also sent them, if you have a family employee, do you have all these things? So I'd made these little checklists up and I mailed them to every client I had. Particularly assigned, my receptionist was thrilled to do this. So I sent them to every single client, and one of my siblings actually called me and he said, I'll tell you, he said, what the hell is this stuff? And I said, well, actually, it's just something to help you out. It's not all inclusive, it's not perfect, but it was stuff that I felt like maybe you might know or maybe you don't. And maybe it could save you money down the road, or just give you some information that you didn't have. And he's looking, he's like, I'm not doing this. This is just crazy. And I said, that's fine, you don't have to do it. But if the IRS walks into your office and you don't have an I-9, don't call me and complain, because I gave you the opportunity to comply with that. And he said, all right, I'll give it to my wife, I'll get it back to you. But it's funny because I sent those out in December and January, December of 2011 and January of 2012. I still have clients, 2013, calling me and saying, you know, I'm getting around to these things and I'm wondering, what does this mean and how does this work? And I had a client that came in just in January and she said, you know, I was looking at that checklist and does it mean that I have to have that for every employee? Yeah, it does. Well, can I get some of those packets? Because there's some of us that, I'm sorry, but we didn't do that stuff. I said, yeah, certainly. So she's becoming compliant. So it's something that I thought was important, but ultimately the lecture, I think, had a good analogy, because you don't necessarily see some of the things that could cause you some of the biggest problems in your small business. And mosquitoes bite, elephants don't. It made a good reference, and as goofy as I thought it was, and as awful as I thought the day was going to be, the 2 days actually, it was actually really, really good, and I think it turned out nice. I sent out the stuff, and I like the way it turned out, but I mean, there's so many things. I mean, you could talk for 3 days and we wouldn't cover everything. So, but I tried to pick out some of the big stuff, and I thought I'd answer your guys' questions. So,
do churches have to have those too?
Churches have to have. Oh yes, definitely. For employees, oh yeah. There's nobody exempt from that. If you are an employee, you should have filled out those forms. The forms are a W-4, an IT-4, an I-9, and if you're in Ohio, an Ohio new hire packet. Out of those 4 forms, you do nothing with any of them except the Ohio new hire. And that one has to be submitted to the state of Ohio within 20 days of hiring or rehiring someone.
What did you say that was?
Ohio new hire.
Oh,
Ohio new hire form. You can do them electronically, you can fax them in.
we can find that on the website.
Yep, you can find it on the website.
So does an
You can always stop at our office and ask Bonnie, my receptionist, to give you a package.
Does an employer have to do that for the 1099 people?
W-9. No, they're not an employee. Contract labor. W-9 is all you need for a contract labor person.
They never ask, home office never asked for that.
No, just a W-9. That's it. And that's why I did the checklist. Are you an independent contractor or are you an employee? Because the rules are completely different.
Right.
So a lot of court cases on that. You can read many of them. It almost always comes down to about 8 criteria. Who supplies the materials? So if you're the painter and you get there and you've got your scaffolding and your tarps and your paintbrushes and stuff, you're probably an independent contractor. But if you get there and they say, here's your bucket, okay, they're probably an employee because you're providing all that stuff for them. And really, is it one thing that makes that determination? It's not. And if you read the court cases, they really take it as a scale. And there's 4. So could you get 4 on 4? Or there's 8. I mean, you could get 4 on 4 and be pretty equal. Yeah, but it's facts and circumstances as to what the courts make their decisions on. So it's a matter of going through those checklists and determining, is this person under my control? One of the funny ones is, do they have the ability financially to make themselves money? Well, if they only work for you, they don't, because you control what they're ever going to make. So, and there's that's what the criteria are, that's what the thought process is, and there's several of them that they go through to make that determination, which do you have. So,
I'm church treasurer and I work out of my home. I supply the computer programs and everything. So I'm an independent, that's what we've been doing.
Possibly. That's not the only criteria. I would go through all of the items to see which way do the scales tip. Is it more employee, is it more independent contractor? The fact that it's your computer and you bought the software and it's in your house, certainly that leans more towards independent contractor than it does employee.
My paper, my everything.
Yeah. And another church, the treasurer comes to the church.
Right,
The church
right.
buys the computer. The church buys the software. She has to report and have office hours. She needs to be there at 8:30 and she leaves at 4:30 and she gets a lunch. And, do you get vacation? What kind of, all those sorts of things.
I wish.
Yeah. But in that particular case, she does.
Yeah.
There's a vacation schedule and
Yeah. Well, our
retirement.
secretary is considered, an employee because she has set hours.
Yeah. So I would go through the checklist and see on the checklist which things that you fall under more of an employee and which things you fall more on an independent contractor, and then weigh them out to see which one it appears you are.
Okay.
So
We need to talk.
independently. And Bonnie keeps the checklist at the front desk because I have people that ask for them all the time now. So if you say, Bonnie, Jennifer said I could have one of her checklists on independent contractor, she'd say, okay. And she'd dig in her drawer and she'd pull it out. So, and she keeps new hire packets there all the time too. I have clients that stop by all the time, pick those up. So, because you misplace them and years change.
How
And
long ago did you start giving out these new hire packets? Could we have been getting those from you since we've been in business?
Probably not since you've been in business. You're thinking like clear back?
Well,
Like way back?
not all the way back, but,
I don't know if you would have it for you, if that's what you're wondering.
well, yeah, that, a couple other employees, I don't remember doing that. Pete and Robin might have been there for. a
Well,
long
Kyle
time.
always emails me when he needs them, and I always send them down to him. So
Right.
I know he has them. I know he has them recently at least. But what I do is check your employee files, and if you don't have those 4 forms in them, have them refill them out, stick them in the file. I wouldn't resubmit them. I hate to be on camera. I wouldn't resubmit them to the state of Ohio at this point because it's a $50 fine per employee for being late, and maybe
long
you
as
could
we got
plead
one file.
stupidity. I'm so sorry, I didn't know. So, beg for forgiveness.
So how long do you have to get that in?
20 days from the date you hire or rehire an employee.
We're past it.
20 days.
I started in January.
Yep, 20 days. It's not long. And the way that actually didn't even come about until 1997, I believe it was. And the whole point behind the Ohio New Hire Forms was because deadbeat parents And what happens is the Ohio New Hire form reports it to Children's Services and Child Support. So then you get a letter from Child Support that says, we see you've hired John Smith. And John Smith has outstanding child support and a garnishment to his wage. You now need to start withholding that. Or Jane Smith, it doesn't matter. But doesn't matter which direction. But that's actually how it came about. Ohio New Hire requirement was because they were trying to catch deadbeat parents. They were moving from job to job and they weren't able to keep up with them. So that was how they devised a plan to catch them.
And to claim a home office, it still has to be a room totally just for an office.
Yes, it does. And there's a lot of court cases that you will lose if you try to take something that isn't a room of its own that you can close the door. And it better not have, you know, if it has. There was a court case recently that it's sad, but this lady prepared tax returns. She wasn't a CPA, she wasn't an enrolled agent, and this is a story that actually comes from my continuing ed. She prepared tax returns. This guy was in Northern California, a small little town in Northern California, and this lady called him and said that she thought she had a problem, that she was being audited by the IRS personally, and the agent came to her house to see her home office. Well, her home office had like a day bed in it, and it had a television, and they determined she didn't have a home office, that was a bedroom, and you know, probably wasn't used predominantly for her business. And then they decided they would check returns that she prepared with home offices, and it went from bad to really, really bad. And she's no longer practicing. She's out of business and not in very good shape from what he says. So I don't know, but no. If you have a desk in your kitchen, that doesn't work. If you have, like my office at home, I have a nice big area in my family room, and no, I can't count it. It has to be devoted to office space, and it better not be too plush. I mean, you can't take a nap there. You can't watch TV there. You better plan to work while you're there. So, and if she'd have been really smart, the agent would have scheduled that appointment. It wouldn't have been just drop by, hello. But you could have prepared yourself a little better for that. But anyways, not proposing anything there. I'm just saying. Anyways, but planning, it's important. So
one of your clients, who's also one of my clients, is getting audited. What's the rule on that? How do you know if you might be up for an audit?
Audit is determined in a multitude of ways, actually. If you are talking about an individual audit, what they do is they rate tax returns. So let's say that you have a husband and wife, they both work W-2 jobs, they deduct real estate taxes, mortgage interest, they get an interest statement for income from their bank, and they get a dividend statement from a few places they work. What's the likelihood the IRS wants to audit them? Almost none, because they've got independent third-party people to say, this is what we paid them, this is how much interest they earn, this is how much they paid us in mortgage interest. You can't really screw that up. You know, I mean, it is what it is. Let's say that you are the husband and wife, and you have a sole proprietorship. You determine what you have as income. You determine how much you get to take in expense. Who reports that to anybody? Nobody. You report it to the IRS, and there's no independent third party there. Does that make it possible that your return could have a mistake more than the return that I just explained a minute ago? Definitely. So
we get a 1099.
Well, okay, this is a perfect example. You got a 1099, your 1099 was for $10,000. How much did you report as income on your return? $10,000?
Whatever was on the 1099.
Did you not have one single cent that came in from anywhere else at all besides that 1099?
Well, yeah. I mean, you report it.
But that's one of the things that the IRS, that's one of the things that the IRS, that's one of the things the IRS will watch on a business. If you report exactly the amount of your 1099 and nothing extra, very unlikely that that's the case, because every single person you dealt with sent you a 1099. Probably not. And if you are somebody that just adds your 1099s and says, they'll never figure out about that other stuff, no. They also do cost of living audits now, and I've had more clients caught up in that than what they have with the other. And the way they do a cost of living audit, they like to pick on people that have cash-based businesses, fair vendors, festival vendors. I have several of those. Do you go to the fair and buy your corn dog with your credit card? No. Debit card? No. A check? No. What do you pay them? Cash. So is it easy for them to not necessarily report all that cash? Well, maybe. So of course none of my clients would do that. So anyways, what happens at that point? The IRS comes in and they do a couple of things. They first go to your bank and they ask your banker, I would like to see all the reports that they file reporting their income to you to get loans. Some people are dumb enough to tell the bank that they made $100,000 and tell the IRS they made $50,000. And that's their first place they catch them. The second thing that they do is they take and add up all of your bills. So what's your mortgage payment? What's your insurance on your house? How much is your car payment? Fuel? How do you, eating? Whatever. And they back into the number. And if you say that you made $50,000 but those bills are $80,000, how did that happen? How did you pay? You're not delinquent. Okay, did you get a gift from your family? Did you get a gift from someone? If you can't prove that, you're too bad. You're out of luck. So that's another way that they do it. But they score returns. So if you have a perpetual entrepreneur, I have a few of those that they have, 6 Schedule Cs going at one time. Is the likelihood of their return being audited better than that person that just has a couple W-2s? Yes, it is. But audit percentages are pretty low. I mean, you can go on the IRS's website and look at them. Most of them are single digits or less. So.
Well, we've been told, because since we have had a home-based business, we've always had a tax person do our taxes. So
Yeah.
in other words, we haven't just, throw stuff in and do it ourselves.
Yeah, and that helps.
Yeah, that's what he told us. If
Yeah,
you
that
have
helps.
me do it each year, or someone like me, he said, you're less likely to be audited because you are.
And that
trying
is-
to have a professional do it.
And that is true, because what happens a lot of times with that is that people deduct things and don't necessarily know that they can or can't. And people like me, well, number one, hopefully I know, but I have continuing ed that I have to go to, 40 hours a year. In addition to that, the IRS requires me to pay a price to them for my preparer PIN number. So if they notice that preparer PIN Jennifer Agin, which isn't that, it's a number, and they pull me up and they say, every return she prepared got a refund this year. Seems a little odd. But that's how they actually, there's been many accountants that have gotten into trouble, and that's how they now start tracking you, is in that regard. In addition to that, there's going to be a big change with the people that prepare returns, because the law is changing and the IRS is requiring you can't just put the sign on your front door and prepare tax returns. You're going to have to pass tests, and you're going to have to be required to do these things in order to be able to prepare the returns to submit them to the IRS. I think those are great things. But there are a lot of people that are fighting that. Obviously, all the folks that, I don't want to say any names, but there are chain businesses that, and I know it personally because I had a nephew that had a degree, not in accounting, but in business, and one of his friends had opened a chain, tax chain, preparation chain, and he's like, I think I'd like to try that. He had a weekend class, and he was set free to prepare tax returns, and I was just shocked. And so he's at my house, and he's all excited because he had his weekend class, and so he's going to test me. I'm like, oh God, go ahead. So it was just hilarious. I'm like, you have no idea what you're talking about, but whatever. So, and he actually met with people starting in January and prepared tax returns. He didn't like it, so he quit after the first tax season, and has never done it before, or after. Never took tax class, but he did it for a weekend, and they allowed him to prepare tax returns. I went to school, let's see, for 5 years in undergrad and 2 years at grad school. But he learned all of that in a weekend. So, I don't know.
I think it's good that they do have to be tested. I mean, that protects you as the tax preparer, but it also protects all of us that come to you to have them done.
There's a big difference. There's a big difference between, you know, there are people that just prepare these returns out of their, they still do. I mean, it's not all finalized yet, but there are people that still do. And what happens, and I've gotten clients from these places, is that unfortunately they run into some major problem and they have to seek somebody that's more expensive. And there's a reason we're more expensive, because we have to do the continuing ed and we had to pay for an education and we have professional liability insurance, so we actually have we have a reason that we have to do things right. You know, I mean, we have ethical issues. I mean, we have lots and lots of things, that policies and procedures and things we have to follow when you have the alphabet soup after your name, that people without it don't. And that's why we're more expensive than the person that we're operating out of their house. It's just simple. It's just simply how it works. But right now, those folks are fighting the IRS implementing all these rules because it's taking away their livelihood. And, you know, anytime that you're going to have something like that, people are gonna fight you on it. I think it's a great idea, but I'm on the opposite side of the fence. So maybe if I were on the other side, I wouldn't think the same. So, you know, I like it. AICPA supports it. The AICPA has done a lot of lobbying for that, and it's in motion. It's not there yet, but it's in motion. So you'll see a lot of change. And what will happen is, if my nephew went to prepare that return now, he still could do that, but there has to be a CPA review it and actually put their name on the bottom of the return. And it's a big deal, you know. In our office, it's different than some CPA firms. If my name is on the bottom of the tax return, I did it. So if there's a mistake, you're looking at the person that made it. Nobody else can I blame for it. If there's a mistake, I'm sorry. I'm human. I do occasionally make them, but I hate to. But maybe I did, and if I did, I'm going to have to fix it, and we'll have to get past it and make it right. But other folks don't have those parameters placed on them, and we are held to a lot higher standard for things. And
When we first started doing our farm taxes, we went to the person that had been doing my dad's farm taxes for years. And I don't know, he probably did it for 2 or 3 years, and he started saying, you can do this. And I said, I don't think so. Oh, yeah. So I started going, the extension office, you know, always offers the farmer's tax. So I started going to that. So I went up and I asked, I don't know if you know David Miller, he's been a while since, but, and I said, David, can we do that? And he said, what? You know, and I said, well, and he said, Connie, it sounds to me like you know more than what that guy does.
mm-hmm.
Why don't you just start doing your own? If you have any questions, you call me and I'll help you. And so
Yeah.
that's what we started. I've been doing them now for 30-some years.
Yeah. And
It's scary.
yeah, I mean, things change every year. And in a lot of situations, things change. Well, 940s have been a huge problem, because 940s are federal unemployment tax if you have payroll and you pay employees. And the 940s changed in 2011. What happened was, we pay, federal unemployment tax is a particular rate. If you pay all of your state unemployment tax, you get a reduced FUTA tax, which is 0.8%. Everybody's paid it. It's been that way ever since I started practicing in '94. So fine. What happened in 2011? They got the great idea that if the state had borrowed money to pay unemployment claims, because unemployment costs got so high, not all the states could afford it, if they did, the federal unemployment was going to charge them what they called, which was a bad idea, they called it a credit reduction. Now, doesn't that sound like money back? No, it's not. It means you're going to pay more. Nobody can understand that. But what happened was, on the 940, they put one line in, and it said, if you're in one of the states subject to the credit reduction, check this box, and add Schedule A. Well, most of my clients that do their own payroll tax returns didn't see that line. And when they came in to do their tax return, I said, hey, by the way, how did you do on your 940? Did you get all that taken care of? Did you follow all that stuff? What are you talking about? Talking about the new Schedule A that they added. I don't know anything about that Schedule A. Well, then you need to amend your 940 and pay the tax so you can minimize your penalty. So they knew it was happening. My one client that we had to help with it the year before. This year, I told my assistant, I said, just give her a call just to make sure she's good with it so she doesn't forget. So she called her. She said, oh, no, I'm good. I've got it. I did everything great. She came in Wednesday to bring her stuff. And I said, do you have your 940 form? She's like, 940, well, what's that? I said, it's, your federal unemployment tax. And she said, oh, yeah, I did that. Here it is. I said, no, those are your deposits. Do you have your form? Oh, my gosh, I don't think I did it. I said, did you do Schedule A? I don't think I did any of it. I think I completely forgot the whole thing. Okay, well, you need to get it done quickly, and you need to do Schedule A. Another appointment right after that, this yesterday, a big corporation, a big company I have, they came in, and one of the things I asked for is what was your payroll liability so I can make sure balance sheet ties, whatever. And she handed me the 940, and I said, where's Schedule A? She goes, what are you talking about? I said, Schedule A. Schedule A is the one that you need to add, and you add the additional tax. And she said, I don't know anything about Schedule A. Oh. I said, well, you need to amend 2011 and 2012, attach Schedule A, and get the payment paid to them as quickly as you can so you can minimize your penalty. So things like that, things change all the time. I literally get emails every day. Sometimes I get 1, sometimes I get 2, sometimes I get 10, depending on what's going on. And I spend a lot of time reading, a lot of time reading. And we get lots of publications, and we filter those through our office. We have a sign-off procedure so that we know everybody's gotten to read the new legislation, and we pass it through the office. But stuff changes all the time. It could be something simple like Summit County changed their percentage of sales tax. Or it could be something complicated like, something big that we were talking about here, a roadable part. You never know. So.
On the food expense, we do a lot of paying for food for our workers if they are on site. So they can
That's fine. There's a business purpose to that. And that's what you put on it, that they were on site at such and such a client and you provided them with their lunch or their dinner or whatever. You're fine. Questions? Any other questions?
I have a question about the W-9s.
Okay.
Do those have to be resubmitted every year?
No.
Okay. So
No.
I heard from someone that they have to do a new one each year. If you got one on file and everything's still current, then you keep.
Yep, you don't have to change it. Same thing goes with the new hire packets. Just because the W-4 has 1997 on it doesn't mean that your client or your employee has to change it. If they're still married and they still live at the same address and they don't want to change their exemptions and so forth, there's no reason to change it. They don't have to. Once you have it, you never have to have it again. But sometimes things change. People have children, or they get divorced, or they move, or whatever, and they want to update them, and that's fine. You can have multiple copies in the file, but you need to at least have one. So, but people do make changes. That happens a lot when people move and marry and divorce and have kids, and kids go to college and whatever, and they change that amount. So, and that's fine. But W-9s, not unless something changes, address, or maybe they incorporate, or whatever. If they're incorporated, they don't have to give it to you, but it's one of those cover your butt things. So just put it in your file so that you said, well, I tried. I didn't have to send it. They were incorporated. So.
Thanks a lot. We really appreciate your coming.
No problem. Not a problem.
All this information.
Not a problem. Too bad you didn't have a bigger crowd.
Yeah. How can we stay up to date on all this stuff?
Listen to the news. You can subscribe on like the IRS's website if you are interested. They'll send out bulletins. You can sign up for stuff like that. Yeah, nobody likes that kind of stuff. I know.
Or we can have Jennifer.
Listen to the news.
Yeah, we definitely need
Yeah.
her more often than once a year.
I mean, things just change all the time. I mean, sometimes it's just a little teeny thing, and sometimes it's something really big, but we are going to have some really big changes. Unfortunately, we have too much debt, and we've got to figure out a way to pay for it, and that's ultimately what this is going to do in 2014. So, I don't think we'll ever see tax rates as low as what we've had. I just don't think we'll ever see it. From a personal side, we all enjoyed, and still can to some extent, enjoy capital gain rates that are low, but they're starting to take those away from us. 2014, I look for those to probably take another hit. I mean, you could have been a person that sold a stock on December the 31st, which one of the speakers I had was from California, and the guy's name is George Lucas, I guess. He does Star Wars or something, I don't know. Some big, I don't know, I really don't. He was like, who? But anyways, I'm not a movie person. But anyways, he said that since he lives real close to where all this was happening, he said, I wasn't the accountant, wasn't the CPA involved. He said, I wish it was, but he wasn't. But he heard about it, it all talked. But he decided to sell his business in 2012 rather than waiting until 2013. He sold it, I forget what he told me, it was like $85 million, some crazy number, I don't remember. And I think it was more than that though. Anyways, but he said, do you think there was any reason why he decided to do that? There was a huge reason why he decided to do that. Because if he sold it on December the 31st, his maximum tax rate was 15%. If he sold it on January 1st, 2013, what was his tax rate? 23.8%. Saved himself 8.8% on however many millions or billions it was. And if you paid attention to the news, there were many, many, many big corporations, and even small ones. A lot of my clients paid big dividends last year, even borrowed money to pay dividends. Why did they do that? Because qualified dividends were at rate 15%, maximum. Didn't matter what bracket you were in, that's the maximum you're going to pay on it. So I had corporations that had never issued a dividend since they started, but we did last year. Why did we do it? Because we guaranteed ourselves 15%, and I don't think we'll ever see those rates again. I just don't think we ever will. We have too much debt as a country to see that. We'll have to pay for it some way, and I think that's how it'll
Just
happen.
the other day that next year they're talking about a sales tax if you sell your house for the capital gains.
There's always been talk about taking that away. There's talk about not allowing you to deduct mortgage interest any longer. The housing market just started to rebound.
They said it was like you were going to have to pay sales tax.
Yeah.
I understood it right.
That would be a state mandated thing, not a federal mandated thing. So it would be on a state basis that if they'd implement a sales tax, because sales tax is not only done, the first tier of sales taxes at the state level, and then each county in Ohio, we have 88 of them, then can put in the county percent of their sales tax. So there's two facets within sales tax, one that's state mandated, one that's county mandated. So it would complicate things a little bit because the state would have to decide, and then I suppose they just say fall under your rate you're in with your county. I guess it'd probably be all right, but it'd be expensive. Yeah. Federally, you're not going to pay any tax on the house at this point. I've not read anything about taking away the $250,000 exclusion, the $500,000 exclusion for a married couple, and that's gain. We don't live in California, so I don't have many clients selling their house for a $500,000 gain. That means that if you bought it for $100,000, you had to sell it for more than $600,000 if you're a married couple. It doesn't really happen here. So we don't have much problem with that. Even with the oil and gas, I haven't seen that kind of increase. So California, it was a big deal.
But the sales tax, what we understood, the person who told me understood would be on the full amount of the house.
Possibly. I don't know. I haven't read that piece, but
That makes me feel a little better than anything you just talking about.
I haven't read that. I read stuff, like I said, every day. I haven't read that, but sales tax. The most recent thing I've heard on sales tax is that they're contemplating taxing more services that aren't taxed right now. Mine, for example, would be one that is we don't pay sales tax, but we may.
Attorneys.
Exactly.
Even barbers, we've been to the.
Well, barbers, that's complicated or beauticians, because the haircut is not taxable, but if you have your eyebrow waxed, it is.
Yeah, they're talking about having all those services taxed.
Yeah.
Yeah.
And ultimately, who pays for that? We do as the consumer, because the business is just going to pass it on. So, I mean, it's not going to be, to get your eyebrow waxed or your haircut's going to be a little more money. So.
Paperwork too. You imagine the paperwork.
Yeah. Sales tax is a lot of work. Can be a lot of work. And you do that for, in essence, free, because you get 3/4% as a discount. And that's meant to cover your administrative costs. Yeah, I'm sure it did.
We went to see Troy Balderson speak about a week, 10 days ago at the library.
Mm-hmm.
He made a comment about Kasich eventually would like to do away with the state income tax. But the sales tax would more than compensate, expanding to all these other areas.
And there's two schools of thought on that too, which is those that buy pay the tax. But the other school of thought on that is, but there's certain things that all of us have to survive. I mean, you have to buy some food, you have to buy whatever. And unfortunately, that percentage ends up being much higher on somebody that makes a low wage than on somebody that makes a high wage. And so, hence, Republican Democrat fight when you get into that. So, I don't know if that'll happen or
There's a lot
not.
of people that don't have to pay taxes,
Right.
but they
But they
would be
consume.
buying some of the stuff.
That's my
so
point.
They would be
That's my
paying
point.
their share
Because the
that
kids,
way.
if you had somebody that was a single mom that, doesn't pay any tax because she doesn't make enough money, now she pays no tax. If you go to sales tax, she still has to buy her baby diapers and formula, and she has to do all that. So her sales tax, at the end, she's actually got less income to live on than what she had if she'd have paid income tax, because it would have been nothing or small. But
At least that way everyone's paying
you decide. Yeah, it's true. It's true. There's two schools of thought on everything. You can agree or disagree both directions, and this area, a lot of us have a Republican thought process, and we're more conservative here. There's nothing wrong with that. I like that thought most of the time, but not always. But most of the time, I probably do. But I mean, I respect the people, and I respect their decisions and their thought processes, and I like to listen to them and see what their thoughts are. Doesn't mean I agree with them, but they don't have to agree with me either. So makes our world go round, I guess.